Thanks so much for tuning into Talking Point today. I'm your host, Neeraj Shah. Our guest today is Pramod Gubbi of Marcellus. Pramod, great having you. Thanks for taking the time out.
No, thanks for having me. Always a pleasure being here.
Thanks. Pramod, your philosophies of investments, of course, at your house stay consistent. I wonder if the current landscape, which is filled with speculations about interest rates, but definitive movements around geopolitics and a whole host of other factors, bring about slight changes, if not structurally, then thematically, to that philosophy.
Well, not really. We tend to remain bottom-up investors. That's the way we have built our philosophy and the firm and the commitment to our investors. We don't see any reason to change that. We believe our skills lie in identifying high-quality businesses defined as high returns on capital, run by clean, honest management teams with sustainable competitive advantages, which can underpin long-term free cash flow growth, which in turn drives an intrinsic value significantly above the current price. So on those elements, there's absolutely no change. Now, of course, the market is a dynamic place. Prices keep going up and down. To that extent, there could be changes in the position, given that the gap between the intrinsic value and the prices move up and down, which drives our decision making as well as position sizing. So, while there are structural themes in India that we've talked about, the rise of the Indian woman, which has implications in terms of changing consumption patterns, or the domination of the southern part of India, which has implications in terms of micro markets as well as a supply of labor. These underlying themes continue to work in the market, which we try and see if they can add a few percentage points to the growth estimates of what are fundamentally strong companies, which would have been fundamentally strong with or without these themes. But a theme tends to add to that free cash flow growth estimate, which in turn gives us that much more comfort on the margin of safety between the intrinsic value and price. Beyond that, we're not really changing anything materially or meaningfully from our investment philosophy, which remains core to us.
Yeah. So I know, Pramod, that you will say that a belated price movement, if I can use that term, doesn't bother you too much. But I'm still trying to understand, how do you wrap your heads around what's happening in financials per se? You've been constructive for a long time on a bunch of financial assets, including the non-lending financials too. And while non-lending financials hitherto have not been the best performers, what is joining that party? I shouldn't call it a party, but what is joining that club is the lending financials, despite very strong performances from the SBIs, HDFC banks, Kotaks of the world, or reasonably strong performance in certain cases. Somehow the market is not quite warming up to these businesses. The valuation derating has been pretty stark in the case of the HDFCs and the
We're quite comfortable with the underlying fundamental performance of what we believe are quality financials. The names that you mentioned, HDFC Bank and Kotak Bank, we've only increased our position in these banks as the earnings continue to compound, whereas the stock prices have remained pretty much flat for the last.
Pramod Gubbi maybe will join back in a minute. But yeah, Pramod, are you there?
Yes, sorry. Did I?
Yeah, you were saying that you are comfortable. You've added on to some of these because the earnings compounding is there, and you were explaining the reason why.
Correct. So perhaps, it's difficult to put a finger on what's driving this derating, but I think there is a combination of stock-specific as well as the broader market reasons. The stock-specific, we know in the case of Kotak, there's been a change at the top. There's been apprehensions that the change at the top could make the bank in future not as great in the past. We don't believe that. We believe that it's a fairly institutionalized franchise, which should mean sustainability of growth and returns that we've seen in the past. Similarly, with HDFC Bank, we've been through perhaps the largest merger in Indian history. Naturally, mergers come with a little bit of uncertainty. We're quite sanguine about the prospects of the merged entity. In fact, we reckon it adds a leg of growth through mortgage business as well. The market-wide phenomenon is we had almost a decade-long period. There were only a handful of private sector financials which were demonstrating strong growth alongside very low credit costs. Asset quality held up, whereas the rest of the financial space had significant asset quality challenges for almost a decade. To that extent, what had happened was a pool of capital chasing financial stocks was concentrated into these handful which had held up asset quality. We had a period of sort of cleansing, starting with the AQR, where those troubled banks and lenders were forced to acknowledge asset quality issues, which depleted the capital on the balance sheet, and followed on by recapitalization, both by the government in the case of PSU banks, as well as some other lenders had to go to the market to raise money. We're now in an early stage of a credit cycle where you've had these replenished balance sheets, allowing them to drive credit growth. At the same time, some of these lenders have managed to have recoveries from erstwhile asset quality issues. And as a result, the market is seeing that, okay, now we were in a situation where we had 2 or 3 lenders to back. Today, we have far many more options. As a result, that finite pool of capital is getting diverted from the 2 or 3 that they had parked into a whole variety of lenders, which in turn is driving a relative derating, in fact, both absolute as well as relative derating in the quality financials. We reckon, I don't want to call that we will see at the later stages of credit cycle. We would like to see some of these so-called turnaround stories in financials holding up their asset quality. It'll be great for the country if that happens. But as night follows day, there will be asset quality issues. We would rather be parked in businesses or lenders who've had long track records of prudent lending, and therefore that could drive a re-rating back. But even in the absence of any re-rating, we reckon that current valuation give you a little bit of a bottoming out on the valuations, and therefore your future returns could just purely come from earnings compounding, which are handsome by itself. These guys are growing earnings 3% plus.
So I was going to say that now at this stage, maybe buying at 4 times may have been fraught with risk, but maybe you believe that currently the valuation bottom is arrived, and now even if they don't re-rate, but the earnings compounding will still give you 20-25% or thereabouts.
Absolutely. To the extent that investing is all about identifying asymmetrical odds, you reckon, you can't really time the bottom in terms of the price to book multiple, but I would reckon this is closer to the bottom. Therefore, your downside is sort of capped or floored, but at the same time, you leave earnings growth as your primary driver of returns. And in the case of a re-rating, you get a little bit of an icing on top of that. So that is what is driving the asymmetry in terms of value for high-quality financials.
Got it. Pramod, where is it that you believe as a house that there exist current valuations, the biggest asymmetrical odds, not with a time perspective that the gains you believe will happen in a particular point of time, but whenever they happen, the gains might be outsized? Where is the largest asymmetry?
I think we've already discussed this. Private sector financials clearly are standing up on that. There would be other bottom-up opportunities, but from a thematic or a sectoral perspective, given the way the markets have run up in the last 3 years, literally from the bottom of COVID, valuation-driven asymmetries seem to be few and far between. There are structural growth opportunities for those growth investors who want to bet on 5-10 years of sustained growth. There, I think the improvements in the macro as well as micro in specific cases will mean that even without any sort of valuation upside, you can generate returns through intrinsic value compounding itself. And that remains the idea in terms of identifying new picks. But I guess given markets are markets, so therefore you will see some sort of a correction or downside, which will make it even more attractive to buy those structural plays.
Got it. Um, just the nature of IPOs that have come in, and the push by the government or sectors getting created. Yes, they're not nifty names, but a lot of mid-size names and mid-size sectors getting created. Eventually, yes, some of the stocks are rising, but they are largely, you take EMS, take defense, take a bunch of others. They are largely mid-cap themes, Pramod. If you were running a flexi cap scheme currently, or if you were managing a portfolio which is only one portfolio, would that have a larger skew towards the non-large cap space? I don't mean risky. I'm just saying non-large cap versus large cap.
So we do have an all-cap portfolio. We don't really start with the position that we'll have X% of the portfolio in large caps and Y% in small and mid. Naturally, as an outcome, we're seeing a skew towards large caps because we're seeing valuation gaps more in large cap and quality. Instead of just market cap alone, I would also add an element of factor. The factor that's worked in the last 2 years has been more of value than quality or growth.
Got it.
So therefore, we see a little bit of undervaluation in large cap plus quality, whereas small cap and value, we reckon, has overdone a bit and is due for a correction.
Okay. Okay. So that is what I was coming to. If I look at pockets like, let's say, the EMS space, right? Just using that as an example. The stocks were expensive, but then came the growth numbers, Q1, Q2, commentary, and there was further re-rating, if you will. So the expensive became more expensive. You believe that is due for a correction? That space or some other pockets like this?
Yeah, like I said, the themes do add a few percentage points to your base case growth estimate, and those are really attractive. From our perspective, the question remains, are these fundamentally strong businesses? Mind you, we work with the assumption that fast growth will inevitably attract competition. When that competition comes through, do these businesses have anything unique in terms of capabilities which can defend themselves against competition, or which competition may not be able to replicate? That's the fundamental starting point for us. The thematic growth driver is more of an added advantage to the thesis because it adds a few percentage of growth. So we're more bottom-up investors than top-down, but to the extent that there are some decent quality businesses in the themes that you mentioned, I do tend to agree with you. There is very little margin of safety when it comes to valuation versus the current price. We'd rather wait for a potential correction there before we start buying into those businesses.
Okay. The other theme, Pramod, that a bunch of people have told me in the last 3 months that they are looking at very actively or have invested already very actively is healthcare. And particularly pharma, but some other facets of healthcare too, but particularly pharmaceuticals, because people again say that the valuations give comfort and there are factors for re-rating generic exports, US patents, so on and so forth. Any thoughts on this?
Yeah, from a pharma perspective, we only have exposure to Divi's, which is more of, again, a bottom-up story. This is not your usual generic pharma or branded generics sort of a story. It's more of an API plus CDMO story, which plays into its own therapeutic areas. It went through. It's always been the case with Divi's. It does go through booms and busts. We saw that boom during the COVID period when Molnupiravir, one of the drugs it produced for its customers, did really well, and therefore high base effect came into play. On top of that, we had massive inventory build up in China, which has hit the markets and killed pricing in several categories. That has put additional margin pressure. But I reckon we are closer to the bottom of that front. You're never going to time yourself to perfection here. But we reckon we are past both the statistical high base effect from COVID as well as the pricing bottoming out in some of the areas where excess inventory from China has resulted in that pricing pressure. So if you were to take the next 3 to 5 year view, I think Divi's is placed pretty strongly. We reckon, some of the new customers that they won post-COVID, as you can see in the fact that they have expanded capacities coming on stream. More often than not, Divi's capacity expansion follows with a strong period of top-line growth and free cash flow growth. And I think we are in that position where if you were to take a 3 to 5 year view, you will enjoy that sort of an uptick coming from Divi's, having seen the downside over the last year and a half.
Okay. Pramod, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us some thoughts around the consistency of thoughts. Wishing you and team Marcellus and family very happy Diwali from all of us here at BQ Prime.
Thank you so much, Neeraj. Just before I sign off, just wanted to give a disclaimer on the stocks that we mentioned. We own it as a firm, as an individual, my family and our clients. And thanks for the wishes and happy Diwali to the team at BQ and all your viewers as well.
Thank you so much. And viewers, thank you for tuning in this edition of The Talking Point.
I take this opportunity to wish BQ Prime team as well as the audience a very happy and a prosperous Diwali and a great year ahead in terms of investments.